Hey everyone, welcome. We just got the closing bell for, November 12th, and the day after Veterans Day. Veterans Day was a holiday for the bond market, but it was not a holiday for the equity markets. However, we did behave as if it was a holiday. So we saw very low volume yesterday, and that volume did not pick back up today. Actually, so far, it looks like we've got lower volume than we did even yesterday. So that's going to play into the dynamics of this week. Throughout the rest of the week, we're probably not going to see full volume or full participation until at least maybe tomorrow, but more likely Thursday, Friday, and then we'll have a more normal week next week. We are starting to bump into a holiday season though, so these types of weeks are going to become more common where we see this low volume and we lost momentum in that S&P 500. After the election results, the huge jump up and very strong movement for another 3 sessions. And then yesterday's session, we did go and make a higher high, but we ended up closing a little bit lower, still up on the day. But unlike the other days where the low was above the previous day high, lows above the previous day high, lows above the previous day high, we saw that low actually pretty close to the previous day low. So that was an indicator that we're losing momentum inside of the market. And then today, of course, we opened down and then we traded way down before coming back up. Let's take a look at what that looked like intraday. So we opened, is this the correct day? Yes. So we opened and we came down and traded down pretty aggressively and then recovered really aggressively, but then ended the day back down below that VWAP. So there's still kind of this lack of momentum. We're pretty close to that VWAP, so we can't really say that sellers were in strong control at the end of the day, but they were definitely in control for most of the day. And buyers tried to stage a rally late in the day, but in the end, they couldn't keep it up. So that's just another indicator that our momentum in the S&P 500 is waning. At first, it looked like we were going to do a pullback, maybe into that EMA 8, but since we closed above 50% of the range today, it's a little bit more even, and we can call this more like a sideways movement over the last 3 sessions instead of a movement up and then a pullback. So what we're looking for in this market was this is too much too fast, and after a run up like that, we do need a period of pause and consolidation or a pullback. So right now, there's still momentum in this market. There's still a lot of buyers who are interested and probably a lot of portfolio managers who do need to put capital to work for these last couple of months of the year to close out the year strong. So we are probably going to see that money continue to be put to work into the end of the year. So that means a pullback is less likely. Most likely we're going to keep on chopping sideways, especially this week. Because of the holiday. And then next week we'll see. Maybe by the end of this week, we will be near that EMA 8 level, or at least our lows will have come close to that EMA 8 level. And then the possibility of us moving higher becomes stronger. Of course, it could dip a little bit at that point. See, look, this was a strong movement also, a couple days chopping, actually 4, 5, 6 days chopping before that EMA 8 caught up. And in this case, we moved down to the EMA 20, but really it was just a continued chop sideways before a pullback and then a bounce. So we could get something similar. So the same thing happened over here, chopping sideways before a pullback, a deeper pullback this time, and a bounce. And then same thing happened over here and similar thing. So this one was a more successful where we continued to move upwards. Where we went up, we chopped sideways into this EMA 8, never quite hit that EMA 20, and then we resumed our motion upwards. So that's what we're looking for right now. I don't think that will move significantly below that EMA 20. If we do have a pullback to the EMA 20, that's probably going to be the lowest level. But given the strength and momentum of this movement, we are likely to just meet that EMA 8 and maybe the tail or the shadow of one of these candles, like the low may come down and get close to the EMA 20 or tag the EMA 20 because the distance between the EMA 8 and the EMA 20 will be a lot smaller at that point in time. So, but we're not really expecting it to pull back to the MA50 again or lower. So we're just waiting. It might take a week. It might take 2 weeks before we break out of this consolidation and continue to move upwards. At least that's the most likely scenario. No guarantees, but given the strength and the momentum in the markets, that's pretty likely. It's going to be fairly surprising if we lose momentum from here without any sort of news, without any sort of concerns coming into the markets. At this point in time, the markets have pretty much priced in that we're going to have inflation because of tariffs, because of FOMC rate policies. They cut too early. There's no mincing words. There's no two ways about it. They cut too early, and this is an indication the yields on the U.S. Treasury just keep going higher, and that is in anticipation of, well, not 100%, but partially in anticipation of inflation coming back. Why would inflation come back? Inflation would come back because Trump wants to repatriate manufacturing. He wants companies to manufacture in the U.S. and not just U.S. companies. He wants outside companies or international companies who want to do business in the U.S. He wants to encourage them to manufacture within the U.S. as well. That's what the tariffs are all about. And if that happens, then the price from international goods that are manufactured outside the U.S. become more expensive because they have a tariff on them. So that is going to drive prices upwards, and at least on manufactured goods, and that will cause temporary inflation. And but as long as the dollar is strong and keeps on moving up, that's not going to be a huge problem for U.S. citizens. It could become a problem for people outside of the country, but it's not going to be a huge problem. As long as this keeps up with inflation, then that's not going to be an issue at all. However, it does put the egg in the Fed's face. They cut before elections. They should have waited until they were clear about what policies would be put in place after the new president would come in, and no matter what, it would have been a new president because it was either Kamala Harris and Donald Trump. Neither of those is Biden. So there would have been a new president with new policies, and they should have waited to see what those policies would have been, because now they're in this exact situation where they cut before that happened, and now just in the next few months, it's looking like they're going to have to reverse that decision. And they have already had this little yo-yo and this mistake with the sticky inflation, and now they're going to have even more egg on their face with cutting rates too early. So what does that mean if we have elevated or increased inflation? Then we're starting to see it in the various sectors. So let's take a look at our sectors. Probably this one. This one's probably the best way to look at it. Okay. So what we're seeing is financials are doing well. They do well because interest rates are going up. So financials on the upside, that's going to be one theme. Consumer discretionary is still doing well, but I don't know how long that will last, because as financing becomes more expensive, or people start saturating their credit cards, then this could start to come back down. So I'd be very careful with XLY. And then the communications is still really doing well. Anything that gives good yield, like communications, tech, those will continue to do well. What else do we have here? Tech, we have already talked about. Utilities should start to have a bit of a challenge, and they come off their highs. They're looking flat over the last couple of months period, and they are not looking super strong. We've got a lower low right here and a lower high now. So this looks like we may have broken a trend. I wish I had a drawing tool. Let me see if I can get a drawing tool. Oops, that's not it. Okay, so we had this, that's not a straight line. Well, in any case, you can try to guess, just pretend that's a straight line. We've now broken down through that. So it does look like we are looking at a change of trend in XLU that will probably go lower. The real estate sector, same thing. We've been chopping sideways for a long time. That's directly interest rate play. But if the Fed now has to reverse directions and start increasing rates again, that could help real estate. But it just depends on how quickly they do it, how fast the bond market responds to it, and the longer term interest rates responds to it. So I wouldn't be looking too interested in the real estate sector anytime soon. Industrials doing well because we're repatriating manufacturing and construction, a lot of infrastructure. So that would probably continue to do well. So far financials and industrials are looking very good. And utilities, we would want to go play to the downside. And gold and silver, well, if the US dollar keeps up its strength, then the silver and gold will struggle. XLP, consumer staples, a lot of staples currently in the country come from outside of the country, especially China. So that's why we are seeing the same break of trend that we saw in utilities. We saw that same break of trend, and we have a lower high, two lower highs, and two lower lows now. So XLP is definitely look like it is going to come down and pull back. Okay, so we're starting to see these themes start to play out within the different sectors. So for now through the end of the year, at the very least, we would expect to see continued weakness in XLP and XLU, at least relative weakness. Maybe they can move upwards a little bit. But again, if you're a portfolio manager and you need to chase yield right now, you need to bump up your performance for the last 2 months of the year. You're not going to park your money in XLP and XLU, low performing stocks, when the overall market is in a clear uptrend and has strong momentum. You're going to severely underperform. So all of these money managers are going to be taking money out of sectors like XLU, XLP, XLV, all of the safe sectors. Let's take a look at XLV real fast. I think I skipped over that one. Yeah, it's the same thing, downward movement. So all money is leaving all of these areas, including bonds, because that is a low yield, safer product. And then it's going to chase risk. Where are we seeing risk? XLY, XLK, XLC, especially over XL, specifically XLC within the technology sector. SMH it's not quite there yet. So really we're seeing it mostly in XLC and XLY. So if professional money managers are doing it who control hundreds of millions or billions of dollars, then we should probably pay attention and start to focus and concentrate there as well. So that is going to be it for today. Have a wonderful rest of your day, and I will see you guys tomorrow.